So, want to pick a pair and also analyze the real pair and spot out possible area of interest. So let's pick like a GBP USD, for instance, and then let's analyze it together and then see how to spot area of interest. I want you to have all these things figured out by the time you start trading by yourself, maybe sometime next year, or because you don't have to be confused. If you're confused, you shouldn't be trading forex. All right. Now, this structure I'm looking at, it's actually very clear. Even if you go on 4 hour time frame, you should be seeing it that from this time that this market has been moving here, that this guy has been on bullish move. Very neat, right? Now, as a day trader, what you should be focused more on is actually, shorter moves. You don't need to, catch bigger moves as you're day trading because you might go and catch a very big move now, and before you know it, structure will change. And when the structure changes, because of how you are looking at it, you will not know that you're supposed to align yourself with a bigger, bigger structures or the bigger time frame structure, and then you just go and overstay in the market, and then you get yourself burnt. Now, I love trending markets a lot because it gives me this mind that yes, I know how to position myself to get what I want from the market. So basically, if you want to have an edge in your trading career, you need to be able to understand the type of market that really works, the type of market that you should stick to. So I'm looking at showing you how to really, get into trading in a proper way. All right. Now I'm supposed to, if this my sub was still active, I would have been able to reduce the time frame. Unfortunately, I won't be able to do that, right? But I just want to explain some certain things to you for you to understand something. Yes, I see a lot of strategy and a whole lot of things that people put out there. It's actually good. Whichever one works, please stick to it. I'm not telling you mine is the best. So usually when I see a market like this, I just draw my trend line. Okay. Once I draw this trend line, since there is no breakout, I look out for things like breakout. Once I see a breakout, that means I'm trading support and resistance. Understand that support and resistance concept is for breakouts. It's not just for trading trend lines or for following trends. Trend line is actually another concept of catching when the market has broken a particular low or high, and then if you're to get in on a sales or you're to go on buys, right? Now, this market is trending up. Usually, what some people will do is to just jump on it as it's moving, right? Maybe they started saying that, oh, this market is moving, oh, they will just jump into it and then they will start trading immediately. The thing is that it's not like it's bad, but it's actually very dangerous for you to do that. So when you see a market trending up like this, it's broke from somewhere. Market doesn't just start going up from an unknown source. So now see this market that is trending towards the upside. I will come back. So let us trace the roots of the source. If we do not know where the market started trending towards the upside from, where it started going bullish from, it's going to be a little bit hard for us. So I'm going to like remove this thing again so that we'll be able to have the bigger picture of what we are looking at on the screen. So first, it's usually very good to have the bigger picture of what you're trading. You see that I'm actually on a 1 hour time frame. Yes, you can actually still analyze your stuff on a 1 hour time frame. So I've seen, I don't need to analyze all these things to show you that it was bullish. You should use your number six. If you really don't already know that by now, I don't think you should be trading forex. I just want to show you where the market was trapping people in for short sales. This sale started around August 27th, and then it ended around August 20. See, let me see. It ended around. See, it started around. Let's see. Again, it started around August 27th, Tuesday 27th August, and it ended around September, right? All right. So that means almost 1 month. Okay, so now this market here broke out from this range, from this. Uh, I call this flag, right? Because this guy sold for like quite a while, right? So after this sold sales, uh, we had a breakout. So now I want to show you how to spot your edge. Now the thing is, when you spot your edge, that's area of value or area of interest. Area of interest is actually a very good zone where you comfortably get into the market, where the market meets your criteria, where it matches all the should I say all the rules. So first of all, let us set the rules. Now, the first rules that we are going to use to trade is one, we must follow trend. We must follow trend. Two, we must we must spot confirmation rejections. Sorry, not spot. We must spot price rejections at least. Yes, we must have price rejections at least two or more. We are trying to build a strategy. Three, we must confirm engulfing or inside bar. So let us see. Now, so we must follow trend. First of all, what is this trend that we are looking at? First, we are looking at a bullish trend. So are we on number one? Yes, we are on number one. Then two, the rule says that we must spot price rejections. Good. I'm going to delete this guy here. So let's zoom in a little bit into this whole thing to see. Let me see. Take my zoom tools. Good. All right. So we must spot price rejection, obvious price rejections. It turned out that this whole thing here, from here, since the market broke out, it came back and gave us minor price rejection and went up. It has not given any major price rejection except for this. I've seen two price rejections here. Now, the price rejections that I got here were from the bearish side, because if it's trending towards the upside, the price rejections should be from the bearish side. And obviously, this is the price rejections I'm talking about. We had one price rejection there. Then there is also another one there, which you can call it indecision, but it's actually a price rejection because it happened after the last price was rejected. So what happened was that the price was actually really getting too high, and then buyers were losing interest. They said, no, we can't keep buying it. Then sellers started reducing the price. They reduced the price of this market so that buyers can actually buy. All right, it's just like going to buy iPhone 13. We know that iPhone 16 just came out, if I'm not mistaken. Now we are planning that next year we'll be having iPhone 17. By myself, I'm still using 13 anyways, right? And then you go to the market to get iPhone 13, and then they now told you that iPhone 13 is 3 million. It's too high. It's too high. You are the buyer, all right? So the sellers would have to bring down the price of iPhone 13 to like 700, 800, 600 and something or thereabouts before you buy. All right. So when the price gets low, there's a place they will reduce the price to. When you say I want to buy at this price, they will reject it. That's actually what we call price action. When they tell you want to sell it for 800, you say let's do it 500, they will reject it. Probably they have dropped that price to almost 650, 500. You will say let's do it 500. They will reject that 500. The reason why sellers have to reject price on a bull market is because, okay, why is it on a bull? Look at it that our currency naira has been declining. So apparently we are losing value against the US dollars. So when anything comes into our market like that, plus the inflation, there is a surge in increase in products. The things we buy, prices has actually increased due to the dollar gaining, strength over naira aggressively. Now, it therefore means that at this point in time, if you actually agree to buy this thing at this point in time. Let's say you buy it at the rate of 500,000 per iPhone 13. You're likely to even sell it more than that later on because our economy is very unstable. All right. So the sellers actually know exactly the level they can actually take that thing to, so that they don't outrun themselves from the market. All right. So we've spotted two price rejections, and the last rule says that we must spot an engulfing pattern or an inside bar. So let me bring it back. So the last rule says we must confirm an engulfing pattern or an inside bar. So sadly, after all this thing happened, there was an inside bar and there was an engulfing pattern. But the engulfing pattern there, left for me, I would have taken that buy. So I don't want to start acting because I've seen what market played out, how the market did it thing, and then I will start telling you I would have done it that way. No. The thing is, there was an engulfing pattern there. Look at it. This this green candle here was the engulfing pattern. So if I were to take this market, I would have probably just go on and buy at the point of spotting that engulfing. Then my stop loss would be below that place at a certain level where I know, okay, it will be okay for me to risk. Maybe like 25 pips is okay. 25 pips. Now, usually when I'm trading, to be honest with you, I do the first default target I do is I'll scale, I will look at one to one. Where are we likely to have the first positive one to one? I'll look at it. Okay, this is one to one. All right, all right. So market is likely to move. Then I will scale it up to like 1 to 2, and not just 1 to 2, 1 to 2 points something for swap fees and commission or all those things. Sorry for commission. Swap in case we hold it overnight because we don't know how long it's going to run for. All right. So now this is my area of value because this place now market actually has retraced to this level. My actually is getting too much. Anyways, market retraced to this level, and that level, what we were waiting for was we had some confluence factors to put into mind. These confluences are what we use to build our strategy. The way we trade, right, is to build some rules that the market must show us these rules. Whenever it shows us these rules, we are certain that at least 80% of times that I have analyzed this market and backtested, I am sure that if I spot these things, trust me, the market is likely to go that way because I have studied it. So, and let me not extend this whole thing too long. Let me just keep it simple to where it hits the target. And then this guy played us for like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 hours. 13, 14, 15, 16. The next 16, that means we held this market for 16 hours. Damn. So we held this guy for 16 hours. The thing is that, trust me, even if you had entered this buy on 30 minutes time frame or 15 minutes time frame, and you had the almost the same point of exiting this market as me, we'll hold it for almost the same time. So what I'm trying to tell you right now is this time frame thing from 30 minutes and 15 minutes time frame, where you want to exit, the market does not care. If you want to exit at a particular level where someone who entered on 1 hour time frame is exiting, just know that you're going to hold that trade for as long as it's going to run. Do you understand? Because you entered it on a 15-minute time frame does not mean you should hit your TP before time. No, it doesn't matter. But the thing is, maybe you probably would get into early buys, probably somewhere around here, sniper entries and all of those things. It's good. And then you would probably reduce your own target to somewhere good. It's also good because if you enter this market around here, it will be around 1 to 4 weeks to reward. That means if you want to even do 1 to 2, look at where it will be. You don't need to hold it that long for you to probably this time frame. This thing now you should be entering it around 5 minutes, 10 minutes, right? It gives you one to this, 1 to 2. But me on 1 hour time frame, I'm looking for a positive. confirmation to add up to my stuff. Then we move on to another level where we spotted our guy. We spotted price rejection. Look at it. I'll draw this again. This is another area of value. We spotted price rejection, and then we spotted a solid bullish engulfing pattern. To be honest with you, you see this video I'm putting out there, I want to say this with my full chest. If after I tell you this thing, you still dey go define which strategy go work for this, you be mumu. Make I no lie, you be mugu. Because this is actually very simple. To be honest, look for the trend, find all these things and get into the market. Simple, set your stop loss. You dey find one strategy to another. Okay, fine. We spotted this engulfing pattern. This is a rejection. We're on a bull trend, and then immediately we spot it. Wait for it. Like maybe you will just look your chart. They wait make this kind of form finish. And the thing is that we got our stop loss around 39 pips, almost 40 pips. So we have to do 1 to 2 risk to reward. We will be forced to do it. The reason why sometimes you might not get to set your stuff on a resistance level on the dot is because one, on a bull trend, what happened? The market keeps breaking resistance levels. So that means left for me, I would scale this guy till I see a positive, you know, 2 point something. Because if you're risking 39 pips, so just imagine a case where you put in one standard lot here, right? 39 pips will be giving you around $390 loss. All right. So that means um, if you put in 87 pips as take profit, you'll be getting around 870, right? So now, if you put in like two standard lot size, it will be 870 times 2. So $870 times 2. I might be wrong, but let's see. $870 times 2. You'll be getting around 1,740. So somebody like me, I like to put 5 standard lot on this kind of thing. So if $100 gives me, if one standard lot gives me 390 times 5, I'll be losing 1950 on this. My account is quite big. So I'll be losing 1950. So if I do this times 2, so I'll be getting around 3,000, that's 3,900 plus. So that's, if I add this point 2.23 here, I'll be having around 4,000 something. So let's just say uh, 870 times 5, that's 4,350 will be my, like my profit. Do you see? Very simple strategy that you just set it and go to sleep. That's the thing. You set this thing, you go to sleep. Just set it and go to sleep. Just have it in mind that when you get on a trade on 1 hour time frame, you trade less, you take lesser trades. It puts you on the safe side of having to execute many trades. You don't have to execute plenty of trades per week or per day. Less is more. So you don't have to like trade too much because you've already entered one trade. So this thing ran for, I don't want to start counting because of all these small candles, but trust me, let's see when we got in. On Thursday, September 19th, and then we hit our take profit around Friday, September 20th. After a long stretch, what am I trying to explain to you?